Well, should Twitter's shareholders accept Elon Musk's offer? Welcome to the Valuation Masterclass case study, where you'll learn about interesting stocks and how to value them. What's interesting about Twitter is that the board accepted a takeover bid of Elon Musk. The board, not the shareholders. Remember, it's the shareholders that must finally approve this takeover. This is Andrew Stotz of the Valuation Masterclass. Let's get started. Remember, this information is for learning purposes only. It's not investment advice or recommendation. The merger agreement between Twitter and Elon Musk looks like this. What we can see is on April 25th, 2022, the company entered in an agreement and plan of a merger. Now, basically, it's setting up a subsidiary company of a company named X Holdings 1. And X Holdings 2 is the company that's going to be merged into Twitter, and Twitter is going to be consumed there, and shareholders will lose their shares, will sell their shares in Twitter for $54.20 in cash, and then have no rights on the merged entity. So Elon Musk's offer is far below the 12 months high. Here we can see the share price was as high as 70 and as low as about 33. Between July 2021 and January 2022, the share price dropped by half. Now, with rumors around Elon Musk, Twitter's share price started to recover, and we can see the big bump that happened when the announcement came out. However, there's not much upside left given the offer price of 54.5, which is the line that I showed there. So we're just a little bit below that line at about 49 or so. So how does the consensus assess Twitter now? Let's look at that. What we can see is most analysts have issued a hold recommendation on Twitter. If we go back in time, we can see that there was a little bit less hold, but now pretty much everybody's on hold. Also, the median target price is close to the offer price now, which is, you can see also in January, the median target price was 57, even above the offer price. Now, based on that, shareholders should probably accept the offer. Now, before I show you my valuation of Twitter, if you want to learn how to value companies like this, check out my 6-week online Valuation Masterclass Bootcamp. The next class starts on May 23rd. You'll learn practical skills. You'll get tools, tips, and tricks. You'll join a group of inspiring people, and you'll be able to get a job or access to my network of thousands of financial industry leaders. Join for just $797 until May 16th. Just go to valuationmasterclass.com/bootcamp. All right. Let's take a look at the model. I'm going to switch over to the model and go through some things. So here's my value model of Twitter. And at the top here, what you see is the company's name and the details, all the way in the upper right, Twitter, and the valuation period and the last interim period. And if we go over to the right, we can see this is the P&L. So I'm just going to go down a little bit and we'll be able to see the P&L, and the P&L is starting with revenue. So revenue here on line 14 down to net profit. And what we can see is if we just look at the net profit of the company, it has been negative in 2012, 2013, 2014, 2015, 2016, 2017. And it turned positive in 2018 and 2019. But you also see that that was partially attributed to a pretty large amount of tax gain here. So it's a little bit of an exceptional item, I would say. And then that got a little bit reversed here. So it's a little bit strange what's going on. In fact, in the case of Twitter, I would prefer to look at EBIT to try to understand what's happening. What can we see from EBIT here? In 2012, EBIT was 77 negative, then 636, then 539, 450, then 367. It started to turn positive, but barely positive when you consider let's just look at 2021. So here we have 2021. And I want to look at that line, the EBIT line. And what you can see is that in 2021, they had EBIT of 273 versus total revenue of 5 billion. So we're talking about a very, very small amount of EBIT. The typical EBIT margin for this type of software company is very high compared to this. Now, also, we can look at SG&A. That's another factor that I think is significant here. SG&A of this company, and I'm going to come down to the section below. And in the section below here is where my forecasting items are. There's my revenue forecast and the like. But let's just look at SG&A as a percent of revenue. We can see, now it doesn't make sense for these because it was kind of in startup phase. But when we start to look at 2018, 19, 20, and 21, we can see that the average is getting close to about 60% of revenue. SG&A is 60% of revenue. That's huge. In fact, this is where the opportunity lies. So now I'm just going to look into the model briefly and try to understand what's happening. The first thing that we can see is that my forecast, and this also tries to mirror consensus a bit so we can see what consensus is saying, is about 17% revenue growth every single year. And that's going to get the company to go from revenue of 5 billion to 11 billion by 2026. Remember that analysts are forecasting this company before the takeover from Elon Musk. In fact, when the company has the takeover, what's going to happen is it's not going to be listed anymore. It's going to be an unlisted company. And now the next thing is I just want to look at the, let's see. Let's look at the situation when it comes to some other expense and other income. The company sold a company in 2021 and 22, in the first quarter of this year, called MoPub, which is a mobile ad platform, and they got about $1 billion for that. So that's been propping up their earnings. Now, next, I just want to go into the valuation section of my model, and hopefully you can see this. I see Thibaut who says the slides seem to not be moving. Hopefully you can see this now up on the screen. And what you can see is that I've done an analysis. I've looked at the risk-free rate, which I'm expecting at about 2.5 for the future for the US, a equity risk premium of 8, which gives us a market return of about 10.5, and a company beta I'm going to use of 1.1. And if I do that, along with my other assumptions, I'm going to come up with a value of this company at about $30 to $35 per share, using free cash flow of the firm and free cash flow of the equity methodologies. So now let's just look at what would happen if we change the beta of this company. The beta I'm going to change to 1. And when I change that beta to 1, we're going to see that the share price, the forecasted valuation comes down to 33. It goes up to 33 for free cash flow and 38.1. Now, also, I'm going to focus in on a key assumption here that we need to think about. And that key assumption has to do with the return on invested capital. And what I've just done is highlighted that row. And you can see that return on invested capital for 2021 was 6.8%, very low. And you can see that I'm expecting that it's going to improve during the discrete period, but still relatively low at 16.66 for a case of a company that is in the new tech era, shouldn't have a lot of costs, should be getting a lot of economies of scale. And so it's a very low level of ROIC. And finally, what I've done here is I've said the weighted average cost of capital is about 8%. And I'm going to assume that ROIC fades down to about 13.3%. And the result of this, again, as I looked at it from a free cash flow to the firm and a free cash flow to equity, is coming in at about $33 or about $38. Now, there is one last thing that I want to look at. I'm going to go back to my forecast, and I'm going to just say, wow, what happens if Elon Musk comes in and he slashes the SG&A costs, the cost of all of the staff and all that, not the programmers, because that's part of cost of goods and services. But the SG&A, let's just say that he slashes that and brings that down to 40% from where it is right now, which is a massive drop. And let's say that he can hold that 40% for the remaining periods. So let's just say that he can do that. And I'm just going to type in 40. If he can do that, the EBIT margin is going to go from 5% in 2021 up to 29% by the time we get to 2026. And this company is going to be super profitable. Now, what's the value from a perspective of free cash flow to the firm and free cash flow to equity? That's going to cause the value to go to 38 and to 42.6. So even if the company had very strong revenue growth, as we see here, and strong profits going forward, and that would basically mean getting up to a net profit margin all the way up to 23%, we still can't come up with a value more than about $43 in our most optimistic case. So that gives you some background on how to understand this company. But what I would say, based upon what I see in my valuation, the best case that I can come up with is $42 for the value of Twitter with our most optimistic. And let's say if I'm more conservative, I'm going to come in at about $30 per share. So the answer to the question of whether the shareholders should accept the offer is yes, they should. And that is my assessment of what the Twitter board and the Twitter shareholders should do when this offer is put before them. If you have a question about that or an idea, or you disagree, just leave a message in the comments below and let's have a discussion. Maybe I missed something here. I'm doubling revenue and I'm cutting SG&A to get to my most optimistic case. So what am I saying? I'm saying that Elon Musk is making a bad decision because you can't get $52 worth of value out of that. Is that true? I mean, come on, Elon Musk is the man. So let me know what you think in the comments below.